Welcome to Financially Fluent with Ray Godleski of Southeast Wealth Partners. Our goal is to equip you with the knowledge and tools necessary to navigate your financial journey with greater ease and efficiency.
Good morning, Becky, Campolito, and welcome to the next episode of Financially Fluent. How are you today?
I'm doing great, Ray. How are you?
Good. It's been a while since I've seen you.
I know, long time no see. You look wonderful.
A couple hours, right? Yeah. Well, thank you for being on here today. Today, the topic will be estate planning, and there's a lot to go there, so we're not going to get to all the possible things we could do with the estate planning world, but we're going to talk about a few. Got a few questions on that. Hopefully, you're up for it.
Well, if I don't know the answer, Ray, I'll make it up.
Sounds good. Well, speaking of questions, I try my best to ask a trivia question for guests to kind of start us off with. No pressure. I will tell you, I feel like half the time people get it right, so they're not easy softballs. But nevertheless, I will give you a couple of choices. So your choices for today's trivia will be sports, or if you want to do guess what state this is based upon a factoid, and the other one would be this happened in the United States 100 years ago from today.
Second category, the state.
The state question. Okay, let me pull that up and ask you the question. We'll see if you get the answer. This one's kind of special to me, actually. What state has the world's best amusement parks called Cedar Point?
The state of Ohio, where I was born.
Aha, that was easy for you. Yeah.
Do I get anything?
Wonderful. Have you been there before?
Yes, I grew up there.
Okay.
To Cedar Point? Oh, yes, I've been to Cedar Point.
Yeah. Well, my kids, of course, they're mostly in college now, love amusement parks, and we went there the summer of 2020. As a matter of fact, we thought we wouldn't be able to go. We kept checking in with them to see if the park was going to be open that summer, and I love it. That park was amazing, and
a lot of big loops on those roller coasters.
Yeah. Well, life has a lot of roller coasters, doesn't it?
Yep, sure does.
All right. Well, thank you for playing, and if we're going to do trivia here locally, I want to have you on my team. How's that sound?
Wonderful.
All right, cool. Well, let's start off with some estate planning questions. And one of the questions that comes up a lot of times would be, when would some people don't have a will, they don't have a trust, right? That happens. When somebody says, when is a will, maybe better than or gets the job done just as well as a trust, what's a scenario you can envision when that would be the answer?
Would consider people that don't own any real property. So they don't have a house, they don't have a timeshare, they don't have a condo, they don't have any businesses that they own. All of those automatically must be probated. However, if they have a very modest estate and they have bank accounts, maybe some financial accounts, and they can easily designate the beneficiary after they die, that is a great use of a will-based plan, provided they make sure they have all the other documents in place, so if they get sick, someone can access those things while they're alive if they cannot.
Yeah, something else I hear about sometimes is, well, I don't have any kids, so I don't really need a trust. Is that something you would agree with?
No, I don't agree. Sometimes, it's rare that I like using a will-based plan. I do mainly trust-based planning. And the reason for that is it's very easy for the people that come after you to step in and manage your stuff. And if you don't have children, but you do own a business or you have property, it's even more critical that you make it easy for people who are not your children to step in and manage stuff for you. And then they have a fiduciary obligation under a trust to manage things in your best interest, where they don't necessarily have that same obligation with a power of attorney.
Yeah, that's a good point. As a matter of fact, that makes me think of another thing that pops up a lot of times, which is, when you're naming, let's go through the basics on it. People get a little confused between grantor, grantee, executor, trustee. If you wouldn't mind, let's spend a couple minutes just going through the basics. Let's say they have a living trust, sometimes known as a revocable living trust. Sure, it may become irrevocable in the future, but let's go through the basics on the setup there and what things people should be considering. If you don't mind, just kind of explain who are those those people?
Sure. Well, in a grantor revocable trust, while you're alive, you don't need a separate social security number. So the grantor is a person who's establishing it. It's a private document that doesn't have to be filed anywhere. So typically, the people who are setting it up are the grantors. Now, the people who are managing the property at any time are the trustees. And then the people who are receiving those assets are the beneficiaries. Now, for a grantor revocable trust, if someone wants to avoid probate because they don't want the kids to have to probate a house, for example, they can put their house in the trust. They're the people that are setting it up. It's the same as setting up like a little company, a little LLC, such as, if they establish their own business. They're also the first people that during their lifetime are going to be managing that. And then they will also benefit from it because they're still going to live in the house. And then they've got backup people or successors that in that trust, so if they can't manage their property anymore because they become sick, they've got what I call their successor trustees, or it's similar to having a vice president who can step in and then manage it. And then after they pass, they're going to say who the beneficiaries are. But during their lifetime, they can serve in all three capacities.
Right. So let's say someone has their property, their primary home, and you mentioned this trust does not have a separate tax ID. So they want to sell the property, and I'm assuming they're going to get the same tax privilege, meaning for a married couple, $500,000 of capital gains tax-free?
Yes. So let's say you and your wife put your house in the Godleski family trust. During your lifetime, you can do whatever you want with that if it's a revocable trust. You can sell it, you can move the assets in and out. And for tax purposes, as long as you're alive, you don't need a separate tax ID number. You can have a mortgage on the property and put it in there. And when you go to sell it, there are really no separate tax consequences. You would still get your homestead exemption and whatever the IRS allows for the sale of the house.
And then for those folks that are single or widow or widower, if they hold on to the property a lot longer, they'll get up to $250,000 of capital gains tax-free. And one thing that people may not be aware of, which is surprising to me because it's been this way for a long time, is you don't have to take those profits and put them all into the next house. You could rent for years if you want to, still have that capital gain exclusion. I don't know if you've come across people maybe not knowing that, but I think it's good for us, as professionals in this space to remind people of that tax fact.
The last time I checked that, you had to roll those in within a year in order to avoid capital gains.
Yeah, so that's the nice thing. We don't have the CPA on the line today, but I got my, I can't get a CPA to hop on until April 15th, but we're going to have some fun. So, okay, so now let me ask you this. So let's say that let's say it is a married couple, one dies. Is there then a tax ID introduced, or only when the surviving spouse dies does the trust become irrevocable and perhaps need a tax ID?
It really depends upon how the trust is set up. Some people want to hold it jointly during their lifetime and after the first one passes, and it really just depends. I ask people if you want to build in remarriage protection, there may be a separate tax ID that has to be obtained. Think about a trust as an umbrella, and you have little umbrellas that are underneath it, sub-trusts, maybe for you and your spouse, and then after you're gone, it goes to your children, and each of them get their own umbrella. And so whether you have a tax ID number or not really depends upon how it's set up.
Okay. All right. Very good. And I guess executor and trustee, those are the two terms I think people get confused about. How would you best tell the difference between those two terms?
It's just a term of art. For a trustee, that applies to a trust. And so that's the person managing the assets and administering it. Whereas an executor or personal representative is the person who's going to be appointed by the court under your last will and testament to administer your estate. It's similar roles, different terms under different documents. That's all it is.
Right. Right. All right. Very good. Very good. Now, for those that are getting married or divorced or they're having kids introduced, you know, in those scenarios, having when would a living trust make sense, and what's kind of the biggest reason in those different scenarios they would consider doing one?
If someone, it's most people when they inherit money will go and put it in a joint bank account with their spouse. And then the money starts dissipating. And then if they get divorced, they look at their other spouse and they say, gee, what happened to that money I had from my parents? It's not a marital asset. If that money were in a trust, it would be better segregated and better protected against a marital claim. So that's one reason to do it. And then I tell people, if you have a life change, such as Kobe Bryant, he had a trust and he named his first two children in the trust. He had a baby at the point when he passed, and that child was not in the trust because he hadn't called his attorney and added her to the trust. And so they had to go to the court. And so really you want to take a look and build flexibility in your documents so you can add those children in, but especially if you have a life change, your finances change, your health changes, the law changes, you probably want to revisit those documents.
Now you mentioned Kobe Bryant. Is there a way for people to kind of plan ahead and say, if we have future children, have the language in the trust so that new whether it's an adoption or it could be a newborn is already covered, and they're not having to think and go, oh my gosh, I need to update my attorney about this?
Absolutely. And that's typically what I do in all of my documents. I suspect the reason it wasn't done in his documents was because he is obviously going to have a death or estate tax problem. Mm-hmm. When Prince died, for example, he didn't have a will, and over 200 people claimed that he was their father. And so the court had to go through all of those claims and establish that no, he indeed did not have any children. And so I believe that's why Kobe Bryant's attorneys limited it to just the two children that he knew and acknowledged to avoid fraudulent people from stepping forward.
Okay. Yeah, that makes sense. All right. Here's something that comes up I've noticed, and it may not be in your wheelhouse, but I figured I'd ask anyway. I see a growing trend of couples, whether they've been together for a year or 10 years or whatever, they are buying a house, but they're not married. And so I guess the question would be, sometimes I've seen various things happen. Sometimes it's joints with rights to survivorship. Sometimes it's not that way. Any kind of advice around what those couples should, and it needs to be fair too, right? I mean, it's possible that maybe one's doing all the financial things to make it happen, and there's other times when it's more equal. So any kind of thoughts around that?
What I like to do in my planning is I like to have a conversation, because when I'm speaking to someone, I'm always thinking about how things are going to change. And I assume that things are going to change. Whereas most people, when they're starting a business or starting a venture or buying a house, they think things are going to stay the same. And so what I would recommend is that if they are going to buy a house together, which I don't recommend for a variety of reasons, is that they come up with an agreement between the two of them about how that interest is going to be handled. If one of them declares bankruptcy, if one of them loses a job, if one of them passes. Mm-hmm. Remember, anything you co-own with anyone, if you have a car accident, your creditors can attach your interest in that property. Same thing if you pass. It doesn't, depending upon how you hold title to it, maybe you want to leave your half to your loved ones instead of your boyfriend or girlfriend. I mean, all of those can be handled with a properly drafted agreement beforehand and a conversation taking into account what could happen.
Now, let's just say they did it by themselves. They just, would they at the bare minimum, would they need to be notarized, need to have witnesses? What would they need to do if they just for some reason did it on their own?
Recommend that. I really wouldn't. I mean, I think it's a terrible idea because they're not going to think about everything. And It's not a good idea. It's like, would you do your own prenup? Wasn't it
No.
Steven, who was the guy from the famous director? Steven Spielberg. Oh yeah, he did his own prenup with Amy Adams on a napkin one night at dinner. And
Oh, boy.
that napkin was highly contested and litigated during their divorce. So sometimes
We got to put a little salt on your napkin. That way it doesn't get, sticking to your glass.
well, if that's the biggest investment that most people have in their life, it's worth it talking to a professional to get it done correctly. And that way there's no misunderstandings about what's going to happen in the future.
And here's something where I've noticed, you're talking about whether it's a blended family or it doesn't have to be a blended family, but they may have a kid a grown kid, that they're thinking gets less inheritance, maybe no inheritance. Let's say they want them to get absolutely no inheritance. But to me, that might be a possible problem. So what advice would you give in that scenario so that maybe they get a little bit of candy, but just enough to not cause any problems? What would you suggest in that scenario?
Well, in all of my documents, when I interview clients, I ask them, and I'm trying to learn about the personalities in the family. So in the documents themselves, I would have a disinheritance clause, and people are disinherited more frequently than I realized before I practiced in this area. I would also have what's called a no contest clause, where if someone steps forward and they make a claim, then they're completely disinherited. Depending upon the circumstances, want to give that ex-loved one a carrot to go away. But I have found what's absolutely the best thing to do is have a conversation if you can beforehand.
Okay.
Because there's always, especially if you leave things unequally to the children. Some people want to do that for a variety of reasons, and that's fine. But isn't it easier as a parent if you manage expectations while you're alive so your kids continue to talk after you pass? You know the personalities of your kids.
Yeah.
They're not all going to take that news the
Right.
same way. And then you put
Right.
their spouses into it. And that way your kids aren't angry at each other and they continue to love and support each other for the rest
Who
of their
knows
lives.
that quote black sheep might actually start to be a little nicer to you.
He or she may.
Yeah, I don't know how genuine it would be, but, Yeah, I would agree with you on that. Here's something else kind of thinking about, oftentimes, because I work with business owners and you do as well, whether they're a solopreneur, but I'm talking more about the ones that have employees and maybe a family member is in the business. So let's think in this example, we have, the older person started the business, running it, could have a son or a daughter, son-in-law, daughter-in-law in the business, doing good. Like they're actually the ones that maybe the reason their company's doing better than it's ever has. But then you have other siblings that are they're not in the business at all, don't care to be in it. So when you think about how do you balance between being fair to that person that's in the business, but also, the parent, usually the parent's spouse that may not necessarily be in the business, maybe on paper, but not actively in the business. I call it estate equalization, but what are some planning techniques there to make sure that everything is somewhat fair and makes sense, where people aren't feeling left out, but you also don't have the person in the business that's, kind of really made it what it is, not get an unfair shake? What are some things you think about in those scenarios?
Well, I'm always surprised because I've represented a lot of business owners over the course of my career. And I've represented a lot of franchisees of restaurant chains, for example. And let's say you have 20 restaurants. I mean, you'd be surprised that most of those business owners, while they're financially well off and healthy, those individual businesses may not have good agreements behind them, whether it be an operating agreement or bylaws. And really, that is the place where you want to address those issues and make those decisions. Because you can let your children who don't participate in the business get a percentage of whatever you feel is appropriate, but maybe their voting rights are less. So if someone is successfully operating the business and they're there every day and you want them to get more, they can do that more freely. But it really just depends upon the financial, the dynamics of the family and the financial viability of the business. That's what I would say. Start in your operating agreements
Right.
because most people do not plan for that.
Right. Right. Have you seen a lack of buy-sell agreements in place for those situations?
I almost never see one when people first come to me. I'm happy if they have an operating agreement or articles, everybody files articles of incorporation, but most people don't have the other corporate documents. You'd be shocked.
Yeah. And that's where, from a leverage standpoint, it's so easy when there is a buy-sell agreement in place. Nobody wants to have a bunch of assets sitting on the sidelines. You just fund it with life insurance so that it kind of makes everyone whole at death.
And you can certainly do that, but those are the kind of planning conversations that you should be having with your estate planner. I find very few people have planned for the exit or transfer of their business.
And now, a quick message from today's sponsor. If you're looking for advice specific to your situation, then take a look at this episode's sponsor, Southeast Wealth Partners. To learn more about their team and approach, go to southeastwealthpartners.com. Southeast Wealth Partners is a great next step to be financially fluent.
Well, that's going to lead us into the next kind of topic, which is around charities, because a lot of times there's folks that they want to leave their assets to charities, whether it's 10% or all of it or less than 10. And so depending on the situation, one of the things I thought we might talk about, if you're comfortable doing so, is a charitable remainder trust. And I don't want to get into the exact amount of dollars somebody needs to be worth to think about doing it. But I would say, if you got $1 million or maybe $2 million, that might not be your go-to. You may not go to the trouble, so to speak. But let's just pretend someone has north of that. We won't specify an amount. But for a charitable remainder trust, for folks that do have quite a bit of assets, what would be a reason somebody might do that, and what would it look like when they do it?
Well, let's say, for example, someone is going to have an estate tax problem. And so they're going to pay taxes on that, after they pass. So maybe they want to set things up. So those assets, they're still receiving the benefit of those assets, and then they're passing tax free after they die. They may be interested in promoting various charitable organizations. That would certainly be one motivation for doing it.
And then there's donor advised funds that are out there. I can tell you from a financial planning standpoint, for people that have a big year in income, or maybe they've sold some kind of stock or something with a capital gain, either scenario, whether they got big year in ordinary income or capital gain, that's a great year to put money into a donor advised fund. And then some people will even point to that donor advised fund as a beneficiary at death. Have you come across folks that use donor advised funds, and what are some of the things you've seen?
I have had a lot of people that use donor advised funds to support their charitable interest, where they either do it during their lifetime or they set one up and they fund it for after death. One of my favorite stories is about some clients, and they said I could share this. They were charitably motivated their whole life. He had worked in ministry, and so they wanted to give a percentage of their estate after they passed right off the top to charity. And then within that, they actually set up a vehicle where they wanted the children to participate in charitable efforts, and they were going to make the children decide which charity some of the money was going to go to. And these were people who had a house, they had a healthy retirement, but they certainly weren't rich by any stretch of the imagination. And it was wonderful to work with that family and that financial advisor to help set that up and carry out their interests. And then you talk with your financial advisor about what kind of assets are best suited to actually put in that donor advised fund, whether it be retirement assets, if you have them. Sometimes that's a better vehicle.
Right. I love that where someone has got the survivors involved in what charities it go to. Imagine if all the money just went to the survivors or grown kids. To me, doing what you just mentioned is really smart in a lot of ways. One is they're involved in the charity aspect. How are we helping others? But also, who knows? Some of the survivors might not be financially on track, perhaps, and maybe their heart is in the right place. They want to give, and maybe they are giving, but now they're able to kind of give more, so to speak, just not out of their pocket. You mentioned what accounts would go into a donor advised fund. So I absolutely love it when I see people put IRA type money, 401k type pre-tax dollars, where we got a tax benefit on the way in, but if we want that money back out at retirement, that's going to be counted as ordinary income. It's going to be taxable. It could affect other things such as Medicare surcharges, Social Security income, capital gains tax, all that fun stuff. The charity doesn't have to pay the tax.
That's right.
And so, I think that's good stewardship, wouldn't you say?
It absolutely is. And the other thing that I love is occasionally I get a client who is receiving their required minimum distributions from their IRA, for example, and they're making donations to a church or a synagogue, and they don't realize that just by filling out a simple form with their administrator, that money can go directly, the RMD can go directly from their account to the charity. Therefore, they aren't taxed ordinary income on that distribution, and the charity doesn't pay tax on either. They get it absolutely tax-free. And there's a limit of what you can do each year. I believe this year it's around $110,000. It's probably a little bit more than that per person. And so if you're giving $40,000 away to various charities, you can do that. And a lot of people just write that check every Sunday or every Saturday, and they don't realize there's a way that you can write those checks in a way that's to be a better steward and more financially efficient if you can do it from your retirement funds.
Absolutely. And it used to be, you mentioned RMDs, and for our listeners, that's required minimum distributions. And that's where it used to be 70 and a half was the age that you were required to take out minimum amounts of dollars out of your retirement accounts. And with the Secure Act, that changed. It was 72 for like a full second, and then I think the next year it became 73. And for quite a few listeners, your age is 75 for RMDs. But what Becky was saying is, you may have, before you turn those ages, you're probably just used to the money going directly out of your checking account to the, whether it's church or some other charity. And so it's important from a planning perspective to then, when you do turn 70, so that age is still the same. 70 and a half is when you can start to direct dollars directly from your retirement accounts to those nonprofits. And most of the time you're going to save on taxes because you're not receiving it as income, and the charity gets the same amount. You just happen to save monies on off your taxes. So I appreciate you saying that. That's really important. The other thing too is from a timing perspective, one thing people might think about is, and this again, it gets into RMD ages, right? So when somebody's 70 and a half, they can do a QCD, and but their RMD age may not be till 73, right? So that person has an opportunity if they want to. You need to know the full picture, right? Mm-hmm. Maybe they don't have any Roths, or maybe their Roth account's like tiny, $6,000, $10,000, I don't know. But they got an opportunity there, in whether they could possibly convert money from an IRA into a Roth. Now that's a taxable event, right? So they have to pay a tax on it. However, they may be able to offset some of that, by doing a large donor advised fund contribution, or, taking money from that QCD out as well. Just some things for your clients to be thinking about.
That's a wonderful point, and that's why I like to work with financial advisors, especially when I have clients who are charitably motivated, because most people give something to some organization, some charitable organization, and once you reach a certain age, there's certainly ways that you can do that more tax efficiently. But I defer to the financial advisors in those matters.
I got you. So, do you feel like talking about a Q-tip or a slat or
Sure.
not? Or you sure?
Yeah.
Okay. So let's talk about a Q-tip. When would somebody think about doing that?
Well, it's a qualified terminal interest property trust. And the reason why you would do it is, let's say, for example, that you have assets that you want to protect. Maybe you have a tax problem, or maybe you're thinking about, I don't want my spouse to remarry after I pass and leave all of my assets to, including retirement, to potentially a new family. And so what you can do is your spouse still has access to those funds, but it's structured in a way that they're pooling out income principal under rules that you set up to make sure that ultimately the funds are used appropriately and the beneficiaries stay the same. So your children still get the remainder interest. So what you're doing is you're putting a bubble of protection around those assets.
Yes. And then I've seen cases where maybe people are married, but their spouse may not be a U.S. citizen. So, and there's different exclusions, from an estate standpoint. So what might be one of those fun little acronyms that person should consider?
It's considered a QDOT, and I just did one. I have a lot of clients that are international, or they have relatives that are international. And what you can do is you can give them assets in a way that, again, allows them to continue to use the assets during their lifetime, but they can't change the beneficiaries. And that is the most tax efficient way of doing it. But you really need to talk to a professional before you do that, because you can use retirement assets and run them through a QDOT, but the tax consequences are just astronomical. And so you really want to make an evaluation whether or not you want to use retirement. The rules are always different for retirement assets. Retirement assets versus a straight brokerage account.
Right. Okay. Very good. Well, and I guess we're starting to wrap things up a little bit here. What would be one piece of advice you wish more people knew about estate planning before it's too late?
I really wish that more people would just do something. Don't let the fear and procrastination let you fall into the class where 70% of people don't have anything. I see people that come in every day, and if they have anything at all, they did it 30 years ago when their kids were little. And what I worry about the most is most people, you and I, Ray, we're going to end up having some event of disability during our lifetime. And unless you have the proper documents in place, your family, in order to get access to your retirement and assets that are held solely in your name, they have to go to court. Just like Wendy Williams is now, or Jay Leno had to do with his wife, or Britney Spears did. And that is a horrible result. And it only ends if you die or if you make a miraculous recovery. So I wish most people, it doesn't have to be, planning can be easy with a professional. And when you think about our house, the houses are in this area worth at least $600,000. It's worth it to invest some money with a professional who's going to guide you through that process and really make it easy for your family to manage things if you do get sick or after you pass, and you can avoid court completely.
Right. And I think that leads us to kind of a reminder that with estate planning, what state are you in?
I'm in the state of Georgia, yeah, but right. I plan for people in Georgia, but I have clients with assets everywhere, and you really need to take a look at that. And if you have people who aren't U.S. citizens or international beneficiaries, you need to take a look at that too, because the rules do get very complicated.
So let's just say someone is thinking about, I've been procrastinating long enough. I'm coherent right now. My spouse and I are maybe you're not a spouse, could be single, doesn't matter. And you're like, I just need to do this while I'm kind of up for it. But in the back of their mind, they're going, well, I'm living in this state. Let's call it Georgia. I don't know. But I might be moving to Florida or South Carolina or out west, whatever. So maybe I'll just wait till I move. Is it a big deal to do a trust now and then move to a different state? Like, walk us through things they just need to remember and how big a deal it is or how not big a deal that would be?
It really just depends upon the assets that they have. I mean, if they don't have real property and they move to a new state, it may not, you always want to talk to someone that's licensed in that state and see if there's something that may need to be changed. The thing that I worry though about more are those powers of attorneys, because you can't, without creating a taxable event, most of your retirement assets are going to pass by beneficiary designation. And so if you get sick during your lifetime, the way that your family accesses those is through a power of attorney. And power of attorneys change from state to state. So you really want to talk to someone. You want to set something up where you are now and then plan if you move, and just have an experienced set of eyes just take a look at everything. It just may be a little tweak here and there.
Okay. All right. Well, thank you, Becky. Is there any final thoughts you'd like to say before we conclude our show?
No, I just want to thank you so much for giving me the opportunity to speak, Ray. I wish I had more jokes for you and made it funnier.
Well, look, I appreciate you coming on the show today. Hope you have a wonderful rest of the day, and goodbye, everybody else.
All right. Thank you.
So, Becky, thank you so much for coming out here today on our podcast, Financially Fluent. And for our listeners out there, just remember, estate planning isn't just for the rich. If you have minor children, you want to be thinking about it. And even if you don't, at the very least, let's make sure that our beneficiaries are updated, have some contingent beneficiaries in place, and also be sure to have those healthcare directives and your financial durable power of attorney.
Thank you for listening to the Financially Fluent podcast. Click the subscribe button below to be notified when new episodes become available.
This communication is for informational purposes only and should not be considered tax, legal, or accounting advice. You should consult with a qualified tax professional, accountant, or legal advisor regarding your specific situation before making any financial decisions. Investment advisory services are provided only in compliance with applicable laws and regulations. Ray's opinions are not based on the specific financial situation of any investor, so they may be unsuitable for some investors. The information on Financially Fluent does not constitute a solicitation of the sale or purchase of securities. You should consult a professional advisor before executing a security trade or taking any other action based on information contained in this program. Securities and investment advisory services offered through Osaic Wealth, Inc., member, FINRA SIPC. Osaic Wealth is separately owned and/or other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.